Hi, Assalamualaikum. My name is Yasir bin Yusri. So today I will briefly present about Malaysia's international financial flows and their importance to the country's economy. In the context of globalization, international financial flows are crucial for Malaysia's economic growth, financial stability, and global standing. These financial flows consist of four main components, which is foreign direct investment, remittances, portfolio investments, and the trade balance. So for the foreign direct investment, or we call FDI, involves foreign investors owning and managing businesses in Malaysia. This brings in capital, technology, and job opportunities. So next, remittances. Remittances are money sent by Malaysians working abroad and also outflows by foreign workers here. This helps in increasing household income and domestic spending. And then next is portfolio investment. It involves foreign investors buying Malaysian stocks and bonds. These are highly liquid and sensitive to market changes, showing Malaysia's openness to global financial markets. And lastly, the trade balance is the difference between our exports and imports. Malaysia usually records a trade surplus driven by exports of electronic, petroleum products, and palm oil. These financial flows have a direct impact on economic growth, balance of payment, and exchange rate stability. Positive inflows can strengthen the economy, but sudden outflows or financial market volatility may affect stability. And for the study, the focus is on the last 10 years, with special attention to the past COVID-19 recovery period and changes in the global economy. So that's all from me.
Hi, my name is Nur Sabarina bint Rahman. Now I will explain it about a foreign direct investment, which is we call it FDI, and why it's such a big deal for Malaysia. So, FDI is when foreign companies invest in our businesses or infrastructure and also play a huge role in driving in our economy because it boosts industrial growth, creates jobs, and even bring a new technology in Malaysia. For instance, the electronics and electrical, which is E&E industrial alone, make up over 40% of FDI's inflows. Other than that, some of our key investors in Malaysia, including Japan, Chinese, Singapore, and even the USA. Other than that, a great example I can give you is Chinese. Chinese involvement in the big infrastructure projects like ECRL, which is East Coast Rail Link, which highlight Malaysia's importance in the region. So, why does Malaysia attract so much in FDI? Let me give you guys some factors, which is first one is because our location is a major advantage because we are right in the heart of Asia, easily giving investors access to a market over 600 million people. Second one is because our government has done a great job with the initiative like MIDA tax incentive and investment allowance, which make Malaysia a business-friendly destination. Lastly, because our infrastructure is a world-class, which is a modern parts, highway, and even the digital free trade zone, which make trade and business operation much easier. That said, we do face some challenges, such as a country like Vietnam and Indonesia offer competitive incentive, which can draw investors away. There's also uncertainty from shifting government policy and global factors like trade tension or the COVID-19 pandemic. This issue make attracting and retaining FDI a bit harder. But even with these all challenges, FDIs continue to have a huge positive impact on Malaysia because it drives GDP growth, also creates thousands of jobs such as Intel operation in Penang alone have created over 13,000 jobs and bring advanced technology to our industries. Now let's take a look at two examples of case studies. First one, Intel, that I mentioned before, which is a global leader in semiconductors, has invested over RMB 30 billion in Malaysia. The second one is Forest Society, is large-scale smart project aimed at transforming Johor into the futuristic urban hub. However, it also raised environmental concern, reminding us of the need to balance development with the sustainability. So, these both case studies shows the opportunities and challenges of FDI in Malaysia. Thank you for listening. I will pass to next presenter.
Assalamualaikum, my name is Muhammad Adam Iqbal. So today, I'll be discussing Malaysia international financial flows with focus on remittances. Malaysia plays a unique dual role in remittances flows. It is primarily a sender of remittances due to its large migrant workforce, while remittances inflows from Malaysia working abroad are relatively minor. Currently, Malaysia hosts over 1.5 million migrant workers, mainly from Indonesia, Nepal and Bangladesh. These workers send average of around RM881 or approximately $210 back home each month. This results in billions of ringgit flowing out of Malaysia annually. These remittances have significantly social and economic impacts. For families in the workers' home countries, remittances are crucial for covering basic needs like food, education and healthcare. They also contribute to rural development and poverty reduction. Within Malaysia, while these outflows represent a capital transfer abroad, they are tied to sectors that depend heavily on foreign labour such as manufacturing, construction and agriculture. This labour supports Malaysia's economic productivity, even though the remittances outflows mean funds are leaving the country. Okay, moving on to the regional context. Malaysia remittances pattern differs from many Asian neighbours. Countries like the Philippines, Vietnam and Thailand are major recipients of remittances, which make up a significant portion of their GDP. In contrast, Malaysia's GDP is less reliant on remittances, with remittances inflows forming less than 1% of GDP, compared to the 9% for the Philippines and 15% for Cambodia. Here we see the 2022 remittances growth rate for key Asian countries. The Philippines grew by 4%, driven by lifting of Saudi Arabia immigration ban and diversification of destination. Vietnam saw a 5.2 increase, supported by a strong diaspora in the US and Europe. Malaysia remittances growth was around 5%, reflecting a more moderate economic performance. It also important to note that cost of sending remittances from Malaysia to Asian countries is relatively low, under 3%, which aligns with the United Nations Sustainable Development Goal to reduce remittances costs. However, remittances growth from Malaysia has slowed recently, dropping to 5% in 2022 from 10% in 2021. This slowdown is linked to weaker economic conditions and tighter migration policies. Despite this, Malaysia's ongoing demand for foreign labour means remittances outflow will remain significant. Although future trends may be influenced by automation and policy changes. In conclusion, remittances from Malaysia play a vital role in supporting development in neighboring countries. But Malaysia's own economic growth depends more on trade and foreign investment. These remittances flows highlight the deep economic interdependence within the Asian region.
Hi, my name is Ahmad Adi bin Azmi. Today, I'll be presenting an overview of portfolio investment in Malaysia, focused on trend, composition, and key influence over the past decade. Portfolio investment refer to capital inflow in the form of financial asset, mainly stocks and bonds, where investors do not take ownership or control of the businesses involved. There are two main types. First, equity investment, which involve foreign investor buying Malaysian stock, especially in sector like finance, energy, and technology. Debt investment, where investor buy government securities like Malaysia Government Securities (MGS) and Islamic bonds such as Sukuk, which are particularly attractive to Sharia compliance fund globally. Over the past 10 years, Malaysia has been fluctuating trends. In 2014 and 2015, there were modest inflow driven by regionally growth. However, in 2016, overflow occurred due to uncertainty around Brexit and US rate hikes. The largest outflow happened during the COVID-19 pandemic in 2020 as investors moved capital to safer markets. Since 2021, there have been a gradual recovery, but portfolio flows remain sensitive to global interest rates and investor sentiment. Institutional investors like BlackRock, as well as local bodies such as EPF and PNB, play major roles in this movement.
Malaysia portfolio investment are highly sensitive to global events during the 2008 financial crisis and the 2020 pandemic. We saw a sharp withdrawal of foreign capital. Similarly, the US Federal Reserve rate hikes in 2022 and 2023 lead to significant capital outflow from emerging markets like Malaysia. Geopolitical tension, such as the Russia-Ukraine war, also make investors more risk averse, affecting both equity and debt market here. To improve resilience, Malaysia has introduced several reforms. First, the government launched platforms like BIX Malaysia to increase transparency in the bond and sukuk market. Budget 2024 focused on financial market digitalization to attract more investors. Looking ahead, Malaysia focus on three key strategies. First, promote ECG and green investment, aligning with global sustainability trends. Second, strengthen macroeconomic stability to reduce capital flight. Third, improve investor protection and market confidence. With consistent reform and strategic planning, Malaysia can ensure portfolio investment remain a strong contributor to economic growth. Thank you.
Trade flow-related policy and agreement. The trade profile of Malaysia is largest influenced by the religions and bilateral trade agreement, as well as domestic policy measures to boost export competitiveness and economic integration. Such agreements like the Region Comprehensive Economic Partnership, which is RCEP, and the Comprehensive and Progressive Agreement for Trans-Pacific Partner, which is CPTPP, have refined the relation on Malaysian trade. The impact of RCEP on Malaysian trade. The world's largest free trade agreement, the RCEP includes 50 Asia-Pacific countries such as China, Japan, South Korea, and the 10 member ASEAN bloc, and took effect in March 2022. For Malaysia, RCEP has deep in trade relationship with key partners, especially in export of electronic and palm oil. Next, under RCEP, there have been gradual tariff reductions in semiconductor and electrical goods that about 50% of Malaysia export and increase the country competitiveness. On the other hand, several custom procedures are streamlined by the agreement, which translate for small and medium-sized company, which is SME, into lower compliance costs. But RCEP also introduced new difficult, even as Malaysia secure great access to China market. Competition of other RCEP members like Vietnam and Thailand has stiffness in labor-intensive sector. Furthermore, for CPTPP and its implication, the CPTPP itself, which Malaysia has relative in November 2022, provide access to new market in North and South America, such as Canada, Mexico, and Peru. For Malaysia, this FTA favor in particular the palm oil sector, rubber product, and electronic due to the removal of 95% of tariff between the member country. Malaysian palm oil export, for example, are now paying significant lower tariff in Canada, which has become an alternative market as EU trade barrier to effect. But this day, CPTPP come with the requirement that its member adhere to strict labor and environmental standard, which can encourage cost of doing business. Lastly is domestic policy, which is from the multilateral page. Malaysia has also been seeking bilateral trading agreement to future niche market. MICECA is expected to benefit Malaysia in respect to increase in palm oil export, as India has been one of the biggest buyer of Malaysia's palm oil. At domestic level, National Trade Blueprint and TBP zoom on digital trade, sustained export, and SME competitiveness. Industrial trade in import and export. Trade is dominated by high value added fruit and chemical and skewed to China. Electrician, palm oil product, and petroleum are the key export, and machinery, chemical are the primary import. Rich global development such as the shortage of semiconductor and sustainability pressure and the rapid rise of digital trade are changing Malaysia's landscape. Firstly is electronic. The export workhouse Malaysian electronic and electrical, which is E&E industry, will contribute nearly 50% to its export, remain variance supported by robust global demand for semiconductor. Malaysia is a significant player in semiconductor packaging and testing, including supplying multinational companies such as Intel and Infineon. But Malaysian electronic industry also has hit one, which is excessive depends on import part, especially from China and the US, resulting in trade imbalance in indeterminate goods. Second is competitive pressure from Vietnam and Thailand, which is have lower labor costs and have their tax incentive. Technology change towards automatic and AI, tending to use ever high skilled labor. Second is palm oil sustainability, challenge and market impact, which is palm oil is a Malaysian second largest export, which account for 5 until 6% of GDP. The EU Deforestation Regulation 2023 placed cap on the palm oil import and has punished Malaysia to tap into new market in America and the Middle East. Export of processed palm oil from Indonesia China has have a surge thanks to increased demand for biodiesel. Production has been limited due to labor shortage because of foreign worker bans. Thirdly is trending movement in oil and LNG. Malaysia is a net exporter of LNG but a net importer of refined petroleum because its domestic refiners are unable to meet the country demand.
Looking ahead, Malaysia has several promising opportunities. Innovative like My Digital driving growth in the digital economy, particularly in fintech and e-commerce. We're also a global leader in green and Islamic finance, which attract ESG focused investor. Regional integration through ASEAN and RCEP continues to open up trade and investment opportunity. However, there are challenges global uncertainties like inflation and geopolitical conflict may reduce investor confidence. Another concern is brain drain, where skilled Malaysian move abroad, affecting our ability to develop high value sectors. Lastly is industry like palm and oil and manufacturing face rising pressure to comply with global sustainability standards. Navigating this opportunity and challenge will be key to strengthening Malaysia financial. Okay, for the future trend, opportunity and challenge, Malaysia has implemented several key policies to manage and improve its international financial flows. Okay, firstly, tax incentive like the pioneer status and investment tax allowance attract foreign direct investment, especially in sector like green tech and high tech manufacturing. Secondly is trade agreements such as RCEP and CPTPP open Malaysia to wider markets and create a more investor-friendly environment. Capital Market Master Plan 3 also plays a major role by encouraging ESG and Islamic finance, which strengthen our portfolio investment landscape. Meanwhile, labour migration policies such as bilateral agreement with countries like Indonesia help regulate remittance flow. So overall, three policies interlink and support stable growth in FDI, remittance and portfolio investment. Kurang apa lagi?
Assalamualaikum, my name is Makadini Hakim. So I'm going to present about the conclusion. From the assignment, we can conclude that FDI is important. It can drive Malaysia's economic growth, job creation and technological development. For the key sectors, electronic and infrastructure, for example, E&E industry, Intel and ECRL. For the main investors are Japan, China, Singapore and US. Next is the portfolio investment, volatile but important. So for the portfolio investment, it can provide capital market liquidity and foreign capital affected by global events, for example, US interest rate and geopolitical risks. And lastly, domestic reform aim to improve investor confidence and transparency. So next is the remittances. Malaysia is a major sender of remittances due to reliance on foreign workers. Remittance inflows are low and have minor impact on the national economy. And lastly is the trade policies and agreement. So from the trade policy agreement, we know that Malaysia benefit from trade deal like RCEP and CPTPP and gains in electronic, palm oil and SME competitiveness. So that's all from us. Thank you.